There are preoccupations and concerns, and there have been over the past few months. They've strongly accelerated in July as regards American mortgage and real estate loans. Investors are fairly concerned as regards the losses which can actually occur with these mortgages and are afraid of repercussions. They are slightly uncertain as to who will still have a chair at the end of the musical chair game. And we will give you details on our exposure in this area, but we do consider that our exposure is very minimal. Last point I need to mention has no impact on this particular 6 months, but may have an impact on our industry in a few years. You know that there's a European project which involves the redefinition of the solvency requirements. So what is the volume we need to reach a certain level of earnings? Solvency II is the name of this directive. In our opinion, the evolution here is highly positive to be able to give Europe and European players competitiveness conditions, i.e. Capital required for economic needs and nothing else. We were slightly upset at the beginning of the exercise after what we'd learned and our experience with IFRS, but the commissioners and their teams have remarkably worked on this issue, and today the path chosen is one which will give a more favorable environment both for consumers and high-quality industrial operators. AXA's performance itself, very strong results. You can see here the progress in earnings, 24% all-inclusive, i.e. including winter tour. When you look at the like-for-like situation, you can see that we are strongly aligned with our Ambition 2012 goals. You can also see here new business value 21%, our underlying earnings 29, our adjusted 21. And all of these figures are figures which show strong progress, demonstrating that the integration of Winter Tour is ongoing and is extremely positive, and also that our Ambition 2012 program is continuing to be implemented quite satisfactorily, and in some segments has strong impacts. Now, if you look at life insurance, comparable base, over and above the acquisition of Winter Tour, we can see here progress by about 12%. You know that we should be between 7 and 10, so we're slightly over this average, slightly lesser than last year. Why? Well, because two markets have had a lower performance comparatively during this first semester. French, relatively flat in APE, and Japanese, where there's a slight decline. French market is what I would call the pre-election period, where people are waiting for the candidates' programs and for the elected candidates' program prior to making any investment decisions. We can see our progress versus July of 25% in life insurance on the French market. So you can see that after the elections, business is picking up and picking up strongly. On the Japanese market, this is more a market topic per se. This is the change in Japanese regulations. We had some spearhead products that were very, very strong as far as taxes are concerned. The tax incentives were suppressed for the whole market, so we no longer sell these products. We are going to replace them, but it's taking us a little more time, which explains why the growth on the Japanese market is shorter. Japan had been a very strong contributor to the growth in profitability and earnings. We have now reached a plateau. We will pick up speed again. There's nothing to worry about, really. New business value has increased by 9%, slightly under that of APE. Why? Well, simply because the business mix is certainly a favorable one, but geographically speaking, we are progressing more strongly in those countries where the margins were lower than that of the group, and this explains a slight gap. And in the U.S., on traditional products of life insurance sold to people above 70 years of age, we have changed our assumptions. We want to work on the basis of more conservative assumptions. This has had a temporary impact on new business value. In P&C, this is an extremely interesting market because many people thought that we were going to come back with strong price drops and high combined ratio increases. We can see that the first semester does give us an erosion of that combined ratio at plus 1.6 points, but its natural events can explain three degradation issues. If there hadn't been these natural disasters, there would have been a maintained improvement of the combined ratio. There are now natural disasters that have had an impact. This is not always the case. So we can see here our earnings with a growth at plus 4%. Our range is 3 to 5. We are at 4. When we compare a situation to that of our competitors, most of them are in a flat position. We are still gaining more market share. And something else is very important is the French market, where we have brought in 62,000 new car insurance policies for the first semester. Very, very high results with very reasonable pricing. So P&C is doing well. Now, as far as asset management is concerned, markets can be turbulent, but performance remains beautiful. 20% growth in earnings. A net inflow of assets under management of approximately 30 billion euros over this past 6 months by AllianceBernstein and AXA IM. And, of course, here are underlying results and other ratios that are continuing to improve. Now, all of this, you can see here a plus 19% growth in our underlying earnings. Share of that by Winterthur. And you can see that Winterthur's contribution is one that is purely operational. And you will also see later on that Winterthur does not contribute to our capital gains because in our balance sheet on December 31, we included them. So there is no realized gain stock, so to speak, in the Winterthur transaction today. This continues still to show very strong impact, plus 19% increase in our underlying earnings. All of this bringing us, when we look at the geographic mix of the group, allows us to truly believe that the sources of our results are highly diversified. Of course, there are two major reactors on our engines, i.e. France and the US, but there's a third one, which is now North Europe and Eastern Europe, because with Switzerland having joined us, Germany, where the profitability level is extremely satisfactory, as well as Belgium, we have, I would say, a third operational group. We're producing between 500 and 600 million in results per quarter, which is fantastic. And then, of course, the Mediterranean region and asset management also contributed really strongly. The only place where we see a slight decline is in United Kingdom and Ireland, but this can be explained by the floods in these countries. You know that what has happened in terms of floods in the UK today certainly are one of the worst manifestations of this flooding phenomenon in the past 30 years. The market, nonetheless, is strongly impacted by climate events, which are exceptional. And this, of course, has impacts on the pricing policies on this particular product segment. Prices are increasing by between 5 and 10%, and the coming years will allow us to fairly clearly restore a very interesting profitability level. You can also see our adjusted earnings here increasing by plus 14%. The difference between underlying and adjusted are the capitalized gains. Similar this semester to the first semester of last year. You here have an indicative range between 800 million and 1 billion per year. Last year we had sold up to 1.1 billion. This year you can see our position on the slide, and there are 7 billion here in capital gains attributable to the shareholder. Here you can see what we've done over the past semester and why we are so serene as regards our annual performance in this regard. The integration of Winterthur is also in a good way. The headquarters are closed. We have become owners of the group on January 1. Shutting down headquarters of an international group within 6 months is something that is quite exceptional. I think that 95% of the employees of headquarters have found new jobs, demonstrating that in countries where the employment market is fluid, and then there are no social crises to speak of. Secondly, the social negotiations in different countries as regards the downsizing plans in view of the synergy evolutions. These negotiations have moved ahead, not at the same pace. Germany is always slightly lagging behind other countries, but is not less efficient. As far as this is concerned, everything is doing well. the activity itself is upholding its own. The topic we have now is not so much the extraction of savings, but rather how we can re-energize the business. We need to have some time to be able to align Winterthur's activities to the same level of growth as AXA's activities, and this is what we planned. This certainly will be done at the pace that we have chosen. We have to look at the P&C renewal campaigns in Germany and Switzerland between now and January next year, how fast we are capable of marketing new life insurance products. All of this is progressing normally and quite well. The restructuring program and extraction of our synergy over the past semester, we have extracted about 2/3 of the synergies we expected for the full year, which only represent a small percentage of those that we will extract in the long term. Here again, perfectly aligned with plans. There isn't just the integration of Winterthur, its consolidation. The group is continuing to grow. And I would like to give you a few words here as regards distribution, products, risk and capital management, and human resources. As regards the extension of the group's scope since the beginning of the year, several things have importance have happened since the beginning of the year. The agreement with Monte Paschi on life and P&C in Italy have given us a strong position in Italy. We believe Monte Paschi is certainly an excellent partner. We've been working together now for several months. Things are progressing really, really well. And I'm sure that you will see that the figures here for the first semester in Italy are high quality. We have launched Accumulator in Italy on our own networks. We will also launch this product on Monte Paschi's networks. We here have hunted together with the BNP on the Ukrainian market. This is a new market for us. It certainly involves taking risks on the territory where we were not present. But as regards our core business, when we look at our growth sources in Europe, we can see that the countries of Central Europe and not always those that are EU members are becoming more normalized with very strong growth rates. We're now number 3 in P&C in Ukraine. This is small for the moment, but this certainly is extremely important for the future. We've also signed a partnership with the second largest Greek bank on bank insurance, which demonstrates that when we look at Monte Paschi, when we look at what we've done in Greece, that as regards bank insurance, you don't need to buy the bank to do good business, point number 1. Point number 2, that AXA is an extremely appealing brand for local, high quality and strong partnerships, particularly when these partnerships involve seeking products to re-energize distribution networks. We're delighted with this because this is a very significant source of growth for the future. As far as AXA is concerned, we're continuing to move ahead on our own networks. In France, we have just announced the acquisition of National Suisse, smart portfolio, but 150 agents, 250 brokers to add to our own distribution network. 150 agents, when you already have a little over 3,000 such agents, this isn't necessarily far from negligible, and this will also be synonymous with growth in the future. We're purchasing brokers as well in P&C in the UK. We want to continue to reinforce our position with small and medium-sized companies and enterprises and industries. This also, in our opinion, is a strong initiative. And we can't talk about what is modern. We have to talk about what is new. We have direct insurance and internet, so Swift Cuffer. We've also bought the first such player in Korea and the first direct bank in Hungary as a platform, which is Ella Bank for a long-term products. Also here, we're continuing to work with positive products such as Accumulator. You can see here a product that has been launched in slightly different versions on European markets. We've announced since January 1, not just Europe, Japan, Spain. All of this is called Capital Resource. I even advise that you underwrite. Belgium and Italy. There are 5 new launches that are scheduled between now and the end of the year, and there will be 3 more in 2008. You can see that this is an ongoing business as well. Capital management, capital and risk management, this is important because to have high results, we need to be able to produce them with optimized levels. We here have exited our Dutch activities and our winter tour activities in the US. Although they were very, very profitable in the short term, growth potential and critical mass potential were not up to par. So here we have had a high level of dividends or buyback of convertibles, for example. We've continued our securitizing program, which means that this will continue to grow, and we're relatively ahead of the other market players. We have continued to manage our assets quite attentively, particularly as regards risk categories, and Denis will say a few words on this. All of this is translated by a much higher rating agency evaluation, and we belong to the small minority of players that they feel to be within the excellence model. Also, something else that we've done, very important from a financial and symbolic standpoint, all of our staff now has shares. Only 50% of the staff had shares in December. Today, all of our staff worldwide has shares, since they have all received, except those that already had a significant amount, 50 shares free of charge, to thank them for the fact that in 2005-2006 we were ahead of schedule for Ambition 2012, and there will be 50 more if 2007-2008 continue to maintain us online with these objectives. This is what I wanted to tell you before Dennis goes into the details. You can see that we've had a very strong semester, and that as regards the epiphenomena due to market changes, has no negative impact on our development. I do not know what to say about slide 22, because in fact it only covers no, I'm directly on 23, which is precisely what I wanted. This was simply to tell you how we were going to compare 2006-2007. Here you can see that our underlying earnings have a strong performance. This is an evolution that, of course, can be seen everywhere. So here, life and savings 19%, P&C 6%, asset management 27%, international insurance 70%. Life insurance, Henry has explained that new business has progressed by 11%. Other important points here, the share of unit linked here is higher than during the first semester 2006. We can also see strong growth in the US, 21%. Both as regards variable annuities, where progress is 15%, and life, where progress is 64%. We can see also that progress is strong in the UK and strong in Australia as well, due to a tax change end of June, which has led policyholders to seek new contracts prior to the end of June. Also, a few less favorable points. You will see that France is at plus 2%. Plus 2% is nonetheless very strong performance, because it is plus 2% on a market where average performance is minus 3. So, of course, also minus 10% last year, but just like the market, but our sales performance in life insurance, in group life insurance, was very strong. In Japan, minus 16%, Henri has already mentioned, by explaining that there were products with a very large number of tax incentive products, 2 products actually that were tax incentive products, and this tax incentive was removed. So of course we lost. Germany, you can see modest growth at 2%, plus 2%. I would say that comparison here can involve year 2006, where products, Rester products, which are regulated retirement products, had tax incentive advantages last year that they no longer have this year. Our margin on new business has gone from 22.8 to 21.9, i.e. 0.5% down. Slight regression as far as AXA is concerned for APE, due to the product mix, unit linked, high margin and favorable, whereas the country mix is slightly unfavorable, and I will show you in greater detail on slide 26. these figures. You can see in the last column here one positive sign everywhere except in the U.S. and in Hong Kong. Now, U.S. and Hong Kong, the variable annuities products shown high performance levels, high margins. As far as unit linked are concerned, we had a strong volume-based performance, but this essentially from universal life products sold essentially by third-party networks. And there is a phenomenon on the American market, which is mentioned in the press, which is that, in fact, intermediaries are selling to people over 70 years of age policies, which are then transferred to business banks that then transform them into investment products. So the assumptions for buybacks of these particular shares, which certainly are an intrinsic part of the accounting, have been brought back to zero. We believe that these products would find their way into hands other than those of the initial buyers. So we thought that we had to take much more conservative assumptions to protect the profitability of these policies called Universal Life on the American market. In Hong Kong, nothing to be worried about. A drop in the margin, of course, which is minus 7.9. It's still, the margin is really high, 49%. We had very successful sales as regards unit-linked life insurance products and also group savings, but there's no problem with the margin here. As far as the rest of our territories are concerned, margins have continued to improve. So this phenomenon is really temporary because in the U.S. we have changed the price of our universal life products in the U.S., particularly for policyholders over 70 years of age. And as far as Hong Kong is concerned, we hope to redress the product mix between now and the end of the year. Now, as regards our businesses in all countries, which reported positive underlying earnings growth. I don't think I need to go into greater detail here. And I suggest that we immediately turn to the P&C environment. Every month we give indications as to pricing evolutions as a follow-up to the renewals which have been undertaken in the preceding quarter. And what you can see here is that the dotted line, the horizontal dotted line in the middle indicates that renewals have been undertaken and prices left unchanged. You can see that there are as many flags under the line as there are above the line, so there isn't a real significant impact as regards pricing. Now, if you look at the columns one by one, then you can see here that as far as car insurance or motor insurance is concerned, there's an inversion, a positive inversion of the trend in terms of prices in the UK, whereas we're still slightly negative on prices in most of the other European countries. As far as homeowners insurance is concerned, you can see that prices are on a positive trend. But there are also regular storms and floods and so on, which of course quite easily justify the price increases. In the UK, of course, the floods in June and July should help us to invert the current negative situation of prices in the UK today and become much more positive. As far as fleets are concerned, so with our companies, for example, property, P&C, for example, in the UK, floods should, of course, lead to a hike in prices because the activity of the P&C here, where we have a very important market share, is a business that was very strongly impacted by the floods in June and July. Civil liability now, prices strongly geared, positively geared, except, of course, for Italy, Germany, and UK. Now, the performance here was extremely positive in P&C total, plus 4%. except perhaps in two areas. UK, where our commercial activity remains extremely strong, where we're gaining market share, and then emerging markets such as Turkey at 22%, Asian countries at plus 11, Morocco at plus 20%. So although the weight of emerging markets in P&C at AXA remains weak, nonetheless, this represents strong growth in the future. And what we did, what we intend to do in Ukraine, as mentioned by Henry, should also contribute to this strong growth. Now, as regards here, the impact, we have brought in 631,000 additional contracts during the first semester for individual motor, excluding external growth, and also individual household net inflows of plus 180,000. So it's dynamic management, and we're continuing to gain here market share. Combined ratio has declined. This is the result of the claims ratio, which has progressed by 1%. So you can see that this increased at the bottom here of the table shows that there are 3 points of claims ratio, which essentially stem from the storms in January and the floods in June. And we can also see here the positive developments on prior accident years of minus 1.6 points. Now, as regards expenses, they remain relatively stable. They have slightly increased by 0.2 points. Administrative costs have diminished, and acquisition costs have continued to grow. Despite this deterioration in our combined ratio, we have seen a growth of 6% in our underlying earnings, which was materialized thanks to an improvement in our financial results, excluding capital gains, coming from an improvement in our asset base and in our management, which is aligned with Ambition 2012. Now, as far as taxes are concerned, the load was lower during these past 6 months than it was last year, same period, for two reasons. First of all, a drop in tax rates in the UK and in Belgium, and also very favorable impact of an tax audit in Germany. Now, geographically speaking, you can see that the result of P&C has made progress everywhere, except in those countries which are most impacted by natural disasters, i.e. Belgium and UK, with a global progress of 12% for France. Now, if we turn to asset management, you can see that this continues to be a highly dynamic part of our business. A strong portfolio managed by AllianceBernstein and AXA IM, representing here 14% growth. This comes from very strong net inflow at 33 billion euros, favorable appreciation of market 48 million for the first semester, which means that the increase in our shares has a more positive impact than the drop in our securities. Bonds also transfer winter tour assets under management 61 billion and also a global progress of 14%. If we look at both of our asset managers one after the other, as regards AllianceBernstein, we can see strong progress in revenue and slight also in the underlying cost of income ratio. Also, we have 17 billion of inflow and assets under management that are extremely high. At AXA Investment Manager, we can see here 28% growth, stronger improvement of the underlying cost income ratio at 2.9 points under, meaning underlying earnings at plus 35 million, collect of 35 billion, slightly under that of AllianceBernstein, and 136 billion euros here under management, very close to those of AllianceBernstein. Now, to go from this underlying result to adjusted earnings, then we must say here that we have seen similar slight growth of between first half 06 and first half 07. Now from underlying to net, there are some elements here which require some explanation. So profit loss on financial assets under fair value option derivatives. This is the uncontrolled component of some of our financial assets which appear in our P&L without there having any economic significance, because these are coverage results, which a part of which appear in the balance sheet and others in our results. So this explains negative of 200 million euros, slightly less negative than last year. And also integration costs essentially associated with Winter Tour 464. Exceptional operations were positive last year with a dilution gain of stock options at AllianceBernstein. This year, a slight loss. Discontinued operations, in other words, the Dutch business that we are preparing to sell, so we don't have any results here to display in our underlying earnings, because this will no longer appear in our scope. So this is why it appears in net and not in operational. And also here, goodwill and related intangibles. You know that in under IFRS, you no longer depreciate goodwill, but you still work on portfolios, values, and the life segment, but we also amortize the value of the customer base. And because we have the acquisition of Winter Tour and the increase of brokerage in the UK, we have a slight difference with last year's figure. Now, shareholders' equity roll forward here of 725 billion euros, slightly under fiscal year 06, we were at 47,226. There is an explanation. You can see that net, this represents a gap of 1.5 billion, which is more or less equal to the first red column, i.e. the change in fair value recorded in equity, shareholders' equity. And this is the result, of course, of the hike in bonds. This has no economic impact for us because our commitment to our policyholders have varied in the same way. In other words, this movement is a purely accounting one without any economic impact. The dividend paid out is the result of the first semester, 3.2, and also we have bought back shares for about 650 billion euros. Return on equity, first semester of 21.6%, which demonstrates that the group's performance in profitability is positive. Now, a few words on our assets. First of all, to say that assets invested on behalf of insurance companies represent 610 billion euros. And here, if you look at the bottom left-hand corner, you can see that there are 185 billion that are unit-linked products. So the risk here, of course, is the policyholder's problem, basically. And then contracts with the UK for 33 billion euros, for which there is no risk for our shareholders. So general assets here cover fairly similar situations versus last year. So we have 11% in listed equities, for example, and 3% in alternative investments. Now, for over the past few months, we have seen some concern for one segment in particular regarding these assets, which is very small versus these 610 billion euros, which is the subprime market. Now, the subprime market involves mortgages lent to people with low income, and another category that you must have heard of, which is called US Alt A, which is an intermediate category or class between US subprime and prime, people who are slightly richer but not very much richer. So all in all, we have a little over 2.2 billion euros assets in these categories. There are, what can we say about this? We can say that there are 92% which are ranked AAA, AA with no recent downgrades. and the mark-to-market price has practically remained stable. What we can read is that there is specific concern as regards loans that were issued in end of 2006, beginning of 2007. In other words, they were issued when the real estate markets were at their highest point, issued by banks at a time today where the trend is inverted on the real estate market. Then, of course, the results are not as positive. 90% in three. So here we have 90% AAA, 9% AA, and 1% more or less A. So here we can see as well that the risk share for us is 1%, i.e. approximately 14 billion euros. And as regards the total number, we believe that our position is extremely favorable, and we have no specific concern as regards this portfolio. As far as market value is concerned, this portfolio has not dropped or been devalued, although today this is slightly artificially worked on because of the concerns which can appear without this being underscored by any type of loan downgrading event or asset downgrading event or anything. We see no increase in defaults and so on. As far as accounting is concerned, 83% are treated in AFS OCI. Of these 2.2 billion euros. And when that is done, the 55%, of course, involve here the policyholders' participation, also combined with capital gain assets. Now, some 2.2 billion euros in our 600-odd billion in assets. And the probability of our making a loss on these assets is extremely remote. Also, the drop in here market prices that we've been able to observe over the past few weeks have nothing whatsoever in common with what has happened to the value of our portfolio. And I now give the floor back to Henri de Castries. Thank you for your attention. Right, so since we only have one slide to comment, do you think you can put it up? Thank you. I don't need to get up again. So I think it is very important now for us to analyze our perspectives, outlooks, and from that standpoint, AXA's team is very serene and very positive as regards potential evolution in our businesses, whatever short-term turbulence we come up against. We do not have the impression that the current credit market volatility will have a strong impact on the development of our business as a whole. If we assume that the global economic environment remains favorable, and you have seen the growth evaluations for next year, we are still facing global growth of around 5%. Even though this should slow down slightly, we would still be at levels which are very high. Our businesses continue to be present on growing markets. We also believe that new business in our life business, such as savings, retirement, for example, will progress and grow by 1 or 2 digits. Then we also think that we should see a marginal improvement for the next 6 months because there will be a lesser impact of natural disasters. And also, we're not just facing monetary evolution. We believe that the growth pace should remain quite significant. So all in all, ladies and gentlemen, we consider that we are very strongly aligned on our Ambition 2012 objectives and that our operational performance is extremely positive. We would also like to use this period where markets seem to be slightly excessive in their pessimisms, particularly as regards the market price of our securities here. We'd also like to here extend our share buyback program, and we intend to buy back 45 million AXA shares between the end of the year. So strong results between now and last year. Also development which is ongoing inside and outside the group. And of course, we are relatively serene. I think that when we reach the size of AXA with positive cash flow, with market share gains everywhere, situations where the seas are slightly rough are situations which give us the possibility of making a slightly stronger difference than in the past versus our competition. So I think that we need to be quite relaxed and serene. There you have it, ladies and gentlemen. We're ready to take your questions. Yes. Hello, question concerning subprime, please. AXA IM has offered its clients that it would take back their participation in some of the ABS funds or money market funds. To date, what is the volume that you have taken back in your own accounts? And is this synonymous with the risk for your balance sheet? And second question, Mr. Duverne, you did not comment as regards asset manager. The best each time in the operational ratio, AllianceBernstein and AXA IM 7 and 3 points respectively. Second question as regards market value today in this particular asset class. If I remember properly, IKB has also invested in AA and AAA, and it's a private. I invested in this, and I really wouldn't like to waste any money on there. I'm not trying to sound panicky here, but I'd like to know how this could be impacted in the future. Thank you. Right. So, as regards our operating ratio, I think that there was a slight misunderstanding. If there's a drop here, it's good news. In other words, the expenses are lower and the margin is higher. Now, if we go back to the corresponding pages, which are 34 and 35, another way, page 34, please, first. So you can see that page 34 of the presentation shows us a drop by 0.7 points, meaning that margin goes to 32%. Same is true for AXA IM. The margin has gone from 31.4 to 34.3. So it's an increase in the margin, which stems from productivity efforts and from the fact that expenses are increasing much more slowly than inflow. I'm sorry to ask you to manipulate these slides. I'd love the slide on LIBOR Plus, please. To date, AXA IM has bought back approximately 300 million euros in assets from investors who have wanted to exit the fund because you say it's not possible to give them a price. That's not exactly true. Of course, assets have limited liquidities, but you can always find a price. And it seemed positive to us as regards funds of this nature to continue to offer liquidities to the investors who wanted to exit, while we explained to them that this was not necessarily in their interest to exit the fund. Because the price did not, in fact, reflect the economic reality. And we believe that when the assets will reach maturity, they will be refunded. And perhaps even before they reach maturity, then there may once again be a rational market on these assets. But if you want to exit, well, then you're given the actual price, the real price. And the investors who have decided to exit have done so with prices that had dropped between 11 and 25%. We said it was unpleasant, but we had told them it was not in their interest to exit the fund. And AXA Asset Managers came in at the price where the investors had exited, and there was a small latent loss because we started to invest when the price had been at minus 11, and we are continuing to invest when it is not minus 25. But this is only a few million euros, very small amounts. I'd like to make a more general comment. It seems to me that as an institutional investor, as such as we need to remember the assets under management, under management, 400 billion euros in the group, and Libor Plus is about 1 billion, and today a little under 1 billion. So, this topic is an epiphenomenon. It doesn't mean that we don't have any responsibilities to respect vis-a-vis the market and vis-a-vis our clients. There are three very important points. First of all, full transparency, immediate reactivity, and secondly, advice to customers. As far as this particular case is concerned, we were extremely transparent. We said everything, explained everything. We responded immediately. In other words, we put the cards down as soon as they appeared. And we think that this is a much better position than to wait to do so. And the third topic, which in my opinion is essential, is that we offer our clients solutions and give them advice. As Dennis has said, if people really want to exit, then we give them the cash, but we advise them to stay by telling them that this situation is one where if you take into account the underlying economic value of these particular assets, there's a strong impact between what is happening on the market and the underlying value of these assets. And it is not in your interest to exit when the gap is so strongly negative. And this is what we did. I would also like to say, and that we must not panic. When we face market situations such as these, the wisest market operators are those who take a risk. Why is this subprime crisis so important? Because we know there's a deterioration in the U.S., that interest rates have continued to increase. People who have taken out mortgages don't necessarily have the income to pay for these increased prices. And the only thing here that was collateral for the price of these credits was the value of the house. If the real estate value begins to drop, this will have an impact on the value of the house. These loans were put in vehicles. We've taken all sorts of individual loans, put them in different envelopes, cut up the envelopes again. There will be a loss on the actual asset underlying what was initially invested. But what is particularly worrisome for the market is that there is an entry ticket, which will certainly here have a different impact, but nobody knows which funnel this will come out of at the end, because all of this has been mixed, remixed again, cut up and remixed once more, and we have the feeling we're playing a puzzle game where we have entered losses in the system and we don't know what funnel they'll come out of, whether they'll be global, whether they'll be really focused for some players only, but we are here facing specific concerns, and rational players need to analyze their degree of exposure, and if there are strong gaps between immediate and underlying, then this is an opportunity for reinvestment. Investors such as ourselves have found that long-term rates were artificially low and that risk premiums were artificially low. We are now violently, which is of course a destabilizing factor for most members of the market, we are today applying what is more compliant with long-term rates, and therefore we spread the risk in a more compliant manner to what should be the reality of the future. We're not going to tell you this is a disaster. This is happening violently, and this of course is taking a lot of people by surprise because many people did not know this mechanism was going to be applied. So there are here a large number of stabilization mechanisms which will be implemented. This is an extremely positive situation, and although we're facing short-term turbulence, we should not panic. Let me answer your last question, says Denis, at least I'll try. We give you the value of this portfolio on July 27th. So we updated it 1 month after closure of accounts. And you can see that we've gone from 99.7 to 98.6. So we can give you prices every day, but this wouldn't make very much sense. On July 27th, we were at the heart of the crisis, and many price gaps had already occurred. There was a slight drop in the prices, then of course prices went up again, and prices will change again every day. This has absolutely no impact. knowing that there was a 1 point difference between end of June and end of July, even if there was one additional point dropping at the end of July, then this can be offset by many different mechanisms, as you know, either in our balance sheet or in policyholder participations. So I think that there is a major difference between the portfolios, which is in fact that every 2 weeks the rating agencies lower grades, hundreds of tranches which go from 3A to AA and so on. As far as our portfolio is concerned, we've had no change on our credit rating. So we're not at all worried. We believe these portfolios are very well managed by highly professional teams. Our business, this is something I didn't say enough. I should have begun with this. Insurance thrives off of inverted cycles. What does this mean? We get the money, and then we get the service, where we give the service. Otherwise, we get the service and then we get the money, which is not our case. So what does this mean? Money comes in before we actually make the service available to our client. Well, this means that we're highly liquid. We have masses of cash, tens of billions. And this is certainly one way we have to increase yield is to not pay premiums immediately. But these instruments, these asset-based securities, are less liquid assets, which represent a share of our portfolio, and it is normal for us to invest in these asset classes. But then we have to be good at what we do, and AXA Investment Managers is very talented, particularly the structured finance team. They're highly professional. They sell their products to AXA, but also to the competition. And the performance track record they have is exceptional. And we are delighted to be invested here. And we will continue to invest, and more so, because today we are witnessing market turbulences, which are investment opportunities that we will seize. Microfono. I'm sorry, there was no mic for the first part of the question. I did not hear that question. I'm sorry. This is a fluctuation which is no greater than the one we witnessed end of June, beginning of July. I can't tell you, it changes every day. The situation was not as positive 2 days ago as it is now. We can't hold a press conference every single day to tell you what happened overnight. You know, plus one, minus one on this portfolio. The microphone will be given to you in a few minutes. Please excuse me as regards this portfolio that is now at 500 million August 3rd. How much was it end of June? So now we've gone away from the insurance company portfolio to return to the LIBOR plus of AIM. End of June, about $1.2 billion, which represents a little over 900 billion euros, 926 billion precisely. But there was a drop in value, about 300 million in exits, 300 million euros in exits, and approximately 200 million in value erosion. And I'm sure you've constructed pessimistic scenarios on what this could cost you, particularly as regards your earnings, and including your earnings. Yes, we intend to see an internal rate of return positive of approximately 20%. Because we have advised those of our clients not to exit, but those who did, made a decision on their own. Those who didn't, I think, will recover their money. Second topic, what was your realized capital gain amount for the year? From 800 million to 1 billion euros. Thank you. Any other question? Yes, hello. Adam Jones, Financial Times. After the floods in the UK, are you expecting a drop in the number of homeowner policies that you intend to sell because of the increase in the price? That is a very good question, says Henry. Everything has to be analyzed on the basis of climate change. There is undeniably an increase in the frequency of natural disasters. Now, there is a debate whether this is due to human activity or whether this is natural cycle, but there is an increase in these disasters, natural disasters. And since this usually tends to focus on limited geographical areas, and particularly the areas such as the coasts or along rivers, because this is where circulation is made easiest, not only the frequency, but also the gravity of these disasters are huge. If you look at the storms in New Orleans 2 years ago, this had happened 100 years later, earlier, it would not have cost as much because the development levels were lesser 100 years ago. But of course, because these are highly developed areas, this means that the severity and gravity of the disasters, of course, are worse. We need to see, and we already see what is happening throughout Europe, where we can see an increase in P&C prices, but this is economic reality. As far as motor insurance is concerned, because the frequency of accidents is diminishing and because the gravity of these accidents also is lesser than it was, prices for the consumer have dropped. Also, the frequency of the events here in related to climate change has increased the prices. So as you know, insurance is a business where prices are spread. And this will, as I've said, have an influence on our prices. But this is normal when you are an insurer to settle claims. That's what we're here for. These periods of disasters and catastrophes are the best time. Of course, we don't hope this will happen to them, but this is the best way for us to demonstrate why our business is useful and what service we can make available to them. But there is one point in your question that I'd like to return to, which is the fact that the increase in the frequency of these disasters may emphasize the need for us to be more precise in our analysis, because the real estate risk may not always be compatible with the risk associated with natural disasters. I'm not going to use the UK. I'm going to use the example of the French market. Zones in the southeast of France where people have built houses in areas that they knew to be floodable. So it seems normal, in my opinion. Okay, first of all, of course, this brings to mind the question regarding how rigorously legislation is applied in some areas. We can't say that areas are floodable and then just let people build anywhere they want. But if people do build in floodable areas, when I say floodable, I'm saying particularly floodable and dangerous, then it is, of course, difficult for them to find insurance coverage. But this is only true of a small minority. It is not because people have been flooded once should not walk away with the feeling they will never be insured. This is not at all the case. There are some extremely specific cases where people have taken risks where they knew they didn't have the right to build, and of course then it is normal for them to not find it easy to be insured. But for majority of people, this will essentially mean that they need to reflect on the coverage they actually have, to think whether the insurance policy is really what is important for them. And this, of course, motivates us to give them more advice. And if these climate change disasters continue to occur, then the French flag here in the household insurance was placed for pricing increases, and I have absolutely no doubt that this has already been done on the UK market anyway, increased prices. One further point of specification, market share in homeowners insurance, which is only 4% in the UK, however, very significant, of about 13% for SMEs and SMIs on the UK market. You may believe you are talking about, of course, homeowners, the impact of these natural disasters on homeowners. But the same is true of enterprises and industries. Microphone, please. Otherwise, sorry. Of course, we calculate the amounts that the floods represent, and it is included in our accounts for June, and it will also be included in July in the second half year's results. Approximately 115 to 120 million euros by June 30th for the UK floods. Hi. From Reuters. Question on France Provident, the French insurer. You're a very important shareholder. What is the best solution for you? We are not shareholders. It's the AllianceBernstein shareholders, AllianceBernstein asset managers. But they are an AXA subsidiary, yes, but remember that there is a difference between the investments of insurance companies and the investments made on behalf of our clients. And as a matter of fact, from an ethical standpoint, I don't have to know why, the asset managers of AllianceBernstein have purchased this share, so they believe it's a good investment, and it's up to them to answer your question, not me. But it's your participation. No, I'm correcting you because I would like us to get rid of this ambiguity once and for all. We are not shareholders. Your bank does not own, or it would surprise you, your bank does not own the money that you put in your current account. I don't know where you bank. Maybe you're working with AXA Bank. I have no idea. But I hope you're working with AXA Bank. But if we call AXA Bank on what AXA Bank is going to do with this gentleman's money, you would be surprised if the bank gave the answer. It's the same thing in this case. This is the business of the AllianceBernstein asset management teams and their clients. So it's what we call the beneficial ownership reporting, where we need to report to the Securities and Exchange Commissions of the different countries the total amount of shares held by the AXA Group, without differentiating what is for the insurance company and for the third-party management aspect. But this is third-party management. We have nothing whatsoever to do with that. Thank you for asking the question. It's a good opportunity to finally get rid of this ambiguity within the press. It's not because we talk about AXA under the beneficial ownership report has so many euros invested in these particular investing products or not. We do not have an operational control. The only operational control we have is for insurance company investments. And in the UK, you intend to undertake other acquisitions of the bolt-on small and medium-sized enterprises. Nothing has changed. And what about the rumors that are in the UK press today? There are two things that are constant, in London city. It's smog and rumors. And now, I'd like to return to the topic of subprime US. Do you see any sign of contamination? Because you see that although there are short-term turbulences, there's no need for panic, but this is what's happening today. People are panicking. And why are they panicking? Are they panicking because they see signs of contamination, or... I think this is what we were saying earlier on. We have lived through, if you read the basic and in-depth analyses which were published 6 months or a year ago, people were saying long-term interest rates are at historically low level and the premium levels are historically overly compressed. So everyone was wondering about the risk of the return of inflation. This risk was mitigated by the fact that industrialized markets, developing markets have a labor force that is exerting, of course, pressure on inflation risks. And then their central banks have begun to draw inwards, so to speak. We have seen more and more restricted conditions for loans. The Central American Bank has increased its rate. The Central European Bank has increased its rates. And of course, there is less abundance than in the past. This has an impact on the economic activity. There's one area where the economic activity had been particularly strong and had gone beyond long-term, i.e. U.S., in the real estate market. When credit was easy, a certain number of players loaned the money that American households needed to reimburse the principal, knowing these people had no money, but they also knew that if these people could not pay back as was expected, then they would go on to foreclosure and retrieve their money. But when the income in the household no longer continues to grow as usual, there's an accident. It's not an accident that is market-wide. It's just in this specific segment. And since these have been invested in many different diversified players, there is a panic because we know that the loss exists. We don't know where it is precisely. So it seems that the market has slightly excess panic because we don't know where the loss is at all, so we punish everybody. At some point, some people will have been insufficiently punished and others very much underpunished. So is this going to have an impact on the rest of the economy? This is probably what the central banks and economic authorities are watching over very carefully today, because what is an incident on one market segment has no reason whatsoever to impact the world's economy. As far as the world's economy is concerned, loans are more expensive because interest rates are higher, but the request and the need is still as high as they were, and it should not have an impact in a massive way, except if it is poorly managed. Now, all of the people who survived off the commissions from these businesses will have less commissions because there will be less issuance. I'm sure that you've noticed that there's less issuance in subprime and drawdown loans and other LBO refinancing operations. Refinancing of private equity was very, very easy when credit was abundant with low interest rates. It has become much weaker. All of these operations today are going to be much less numerous. People who were commissioned will be less commissioned, but the demand from the final consumer and the investment of enterprises, which are the two drivers of long-term economic growth, are not impacted for the moment at all. So as an experienced institutional investors, how can you compare what is happening today versus what happened in the past? Well, it's an interesting question. You know, there are differences, but there's something that is close to the John Bones crises in the 90s and with the panic on the equity markets in 2003. I think that when we look at what has happened on money markets, there's a fantastic bit of news, which is that these markets have grown, become more professional, and have multiplied their vehicles. So far from considering that this is an evil, I consider this to be a good, because there's much more whatever monetary mass exists, whatever the monetary policy is, there are more means available today to set up funding arrangements and cash rather than was the case 100 years ago. 100 years ago, you would go see a bank had to bear this component in its balance sheet from beginning to end. And it was either in the form of debt or in the form of equity, two very different categories and classes. Today you have a multiple number of players, vehicles, how to package risk of investments and so on different tranches of risk over different periods of time and over different players. This is what we call fluidification or granularization of the market. This is also very important. We need fluid money markets to have strong economic growth. Now, the counterpart here is that when there is a glitch in the system, it is easier to measure where it comes from. When you had the ITCM crisis, which is comparable, for LTCM, to know what the consequences of the crisis were to be, central banks needed to bring around the table a little a slightly larger number of players than it would have been the case at the beginning of the 20th century. That's the case today. I think around the table for LTCM, they brought about 60 or 70 people around the table to discuss the topic, and they did so very well. Today, things are much more complicated. Because of these transformations, we don't know where the loss is. But the counterpart, and this is why we as insurers are relatively serene here, if there are many more players and many more vehicles, it means that the risk is mutualized. And it means, and I don't mean to be caricatural, I'd like to give you a simple image. The crisis 50 or 100 years ago on much smaller markets, very severe crises, involved one big elephant that died brutally, and the collapse of this great elephant created a destructive shock throughout the system because the loss was focused on a very limited number of players. Today, it would seem to us that we're not witnessing this. It seems that what we are seeing now is not that there are little mice, a lot of little mice losing a little bit of weight, and a few medium-sized animals that are facing real trouble. But it's, for the moment, this is not really a systemic crisis. It is an adjustment that was necessary and is necessary on any overheated market. And the system's capacity for absorption, if it is kept well under control, is, in my opinion, sufficient. The results, the earnings of the companies look at fundamental economic factors. The corporate earnings are very high. The balance sheet structures are healthy. The demand from consumers is high. At the end of last year, when you questioned people regarding the strongest macroeconomic risks they felt, they were saying a recession in the U.S., which would generate a collapse of growth on emerging markets. We're wondering how far the emerging growth wasn't actually American growth. And in fact, we have seen that from the beginning of this year, growth in the U.S. has slowed down, and it's not a recession. But growth remains strong on emerging markets. So all of this brings very strong world growth. So when we take the helicopter view about whether or not this is really a problem or not, it's probably very bad for a number of players. It's probably also terrible for some market segments, but I do not believe that it will challenge the development model that we have used since the beginning of globalization, which is a model where financial markets that are more and more sophisticated and capable of generating cash for all types of risks are feeding a worldwide growth driven by an increase in consumer needs based on healthy corporate earnings. May bring global growth from 5 to 4. I don't know. I may be wrong. This is my personal opinion. I do not think that we are threatened with very severe recession just because some subprime funds are going to have unpleasant business to deal with for a moment. I think that this is an opportunity for many people to make a lot of money. If you look at what happened in Jambons, if you look at what happened when the equity markets collapsed, then the players who were truly professional made a lot of money. As a matter of fact, I think it was Financial Times this morning where we saw performance levels that were positive of at over 300% since the beginning of the year. There are people who are losing money, but there are other people who can measure inefficiencies and know how to make money despite them. Sorry for the length of my answer. Any other questions? If there are no more questions, this session is at a close. Thank you, ladies and gentlemen.